Hello. Um, some of you have noticed already. I'm wearing my bandana. You understand? I can not offend anybody to my hair and I don't have enough trust in my wife, so just covered it up. So today we're gonna keep talking about life cycle partnership, and in the last video we talking about goodwill method. What is goodwill method? Goodwill method basically we acknowledge the existence of self-developed goodwill, but we need some factors to make sure the value of goodwill won't cause any problems. And the factor is, or the determinant is, it has to be agreed upon through some, I think, through some form among all the partners at a certain point of time where the goodwill should be recognized. It sounds complicated, but if you think about it, when we use goodwill method, one occasion is when the company was funded, and the goodwill, which is the expertise of partner C, was recognized, agreed upon by everybody of the partnership. Basically, if the partnership goes wrong or has any change, everybody would be affected. They agreed upon the value of the expertise of car. So that's a that's one occasion, and then that's how it's agreed upon, right? And then, the second occasion in our example is when the company did well for 2 years, the Don one wanted to be part of it, right? So we talked about it. Don wants to be part of it, so there's a structure change. In the first occasion, there's nothing changing to forming a company. Here, there's a structure change. There's one more partner, or there's shares change, whatever, it's an ownership structure change. Okay, so that's the occasion we talk about. And Don, we said, contributed 50,000, got a 10% share, and of course it was agreed upon by everybody. So that's the second occasion, and then from this we know that, okay, the occasion we talk about must be involving ownership change. Ownership change can refer to partner number change, or can refer to partner shares change, or a combination of both. So another thing is the value, the change about ownership has to be agreed upon among all the partners. Okay, so the third occasion we can definitely see why is first there's ownership change, Carl withdraw or ran away, right? And then of course with partner number change, of course there's going to be a structure change, and the value was agreed upon by everybody already, right? So we see that as well. So basically, we are saying goodwill method allows partnerships to recognize self-developed or changing in goodwill, but it has to be at a certain point of time, not all the time, and the value change, whatever change, has to be agreed upon by all the partners, existing partners at that moment at least. So again, we see this partner, the occasion we talk about is when there's no company, to have a company, from 3 partner to 4 partner, and from 4 partner to car run away, right? So those are what we talked about. And if we recall, we also talked about a bonus method a little bit. What is bonus method? Bonus method basically is kind of like corporate GAAP accounting principles, where self-developed goodwill is not allowed, right? Which means, okay, those whatever expertise change, market value change, as long as we are still talking about the same partnership, right? Partnership ownership structure can change, but that's the same partnership. So as long as we are talking about the same partnership, we don't allow goodwill. We don't recognize goodwill. Everything is based on book value. So sounds a lot like corporate accounting we talked about. That's one thing. And what is bonus method again? Bonus method basically says, okay, although, for example, in the case we talked about, although C's expertise is not accounting-wise allowed to be recognized as asset under the name of goodwill for the partnership, but we know that it's still the same partnership in material, and A and B still want C and still appreciates, recognize B's expertise. So although the expertise will not be allowed to be capitalized on balance sheets, but A and B, what they did is they can reduce their shares as long as they relatively have the same portion in the partnership. So they reduce their number of shares, amount of shares, and give it to fee, right? So it's like a bonus to reward the unrecognized, accounting-wise unrecognized part. So in material, C still get its equal share regarding beginning balance of capital, right? Of course, I think after I talk about it, we might have a little bit of idea of the difference between goodwill method and a bonus method, but I'm sure you won't go very far without practicing on it. So let's continue our example, but this time we use bonus method. Here we talk about bonus method. Basically what we have is Adam contributed 100,000 and Betsy contributed 130,000. Adam contributed 100,000 cash, right? This is a goodwill method. For us to start, we said we need what number to start with, all right? So here, let me just allow me to be lazy a little bit. Here we are talking about, you always figure out a ways to be lazy, right? Laziness is what motivates human beings to create so great inventions, right? Because we don't want to carry stuff all around and up to the hills, so we invented wheels, right? Right? Because people don't want too much power or want to take it and make it easy, right? So if we think about it, cash, 100,000 contributed Adam contributed 100,000 cash, capital, that's goodwill method as I talked about. And then we have inventory. Okay, Carl contributed 20,000 inventory and then 30,000 expertise, that his expertise is worth, so it's going to be under goodwill. So 30,000, 20,000, and we know that it's going to be agreed upon, deemed worth 30,000 by all the partners, right? So here, Adam totally contributed 50,000 in the form of 20,000 inventory and 30,000 cash, right? 30,000 cash. And then we have Betsy contributed to land 130,000. So it appears to that Betsy has contributed 130,000, but wait for it. If you read everything, you will see the land carried the 30,000, which was under Betsy's name, but by transferring the land to the partnership, Betsy also got away from the liability, right? So Betsy contributed 130,000 worth of land, but she also dodged 30,000 liability loan. So net-wise, Betsy contributed 100,000 as well. All right. So let's take a look, see what we got. All right. Again, this is goodwill method. How do we tell? It's not too difficult to tell. How do we tell? Let me put this. I always like numbers to be aligned well. Okay. So how do we tell goodwill is here, right? So that's goodwill method. So let's talk about bonus method. What is bonus method again? To start, we have to remember bonus method don't allow the recognition of goodwill. Allow it shows up on balance sheet. So but no matter what, it is still the same company, right? So same company must have the same identifiable assets. I use the word identifiable. Identifiable is all the assets other than goodwill. That talks about those assets you can name. It could be tangible, could be intangible, could be current asset, could be long-term asset, as long as you can recognize these, meaning that present them under a suitable name different from goodwill. Then those are identifiable assets, right? So we only have, without goodwill, we have 3 identifiable assets: cash, 100,000, inventory, 20,000, oops, not 20, 20,000, and land, 130,000, and no goodwill. And then for loan, we still have 30,000. That's no problem. And another issue is what is here, what is here, what is here, what is here, right? So no matter we show goodwill or not, keep in mind, goodwill will always be utilized because Carl came packed with goodwill expertise, right? So it is the same company we talked about, same amount of identifiable assets and the same amount of liability, so it's the same. And if we are talking about the same company, no matter whatever kind of fancy stuff, goodwill stuff, and non-identifiable stuff we add to it, what we need to know is, for example, if you used to have 100% of the company, right? So no matter allowed to show goodwill or not, as long as you still have 100%, right? As long as the company has the same assets, indeed, in material, and the same loan, then you should be fine with it. You don't care about, right? You don't care about what other people tell you, hey, accounting-wise, how much it is. So if you used to have 50% on the goodwill method, you still want yourself to have 50% on the bonus method, because they are literally the same company, just with accounting differences regarding which number is allowed to show up or not. So when we talk about ABC, how much their share is, one thing important is for us to figure out what is total equity and what is everybody's percentage, right? So here we can see here, the total asset add up to 280,000, and here loan is 30,000, so total equity should add up to 240. 240, right? 100,000 of 200, sorry, 250. 100,000 out of 250, it tells us is 40%, and 40% for B, and 20% for Oh, by the way, do I put it? I thought I typed. What am I putting? Okay, better. So we know that A has 40%, B had 40%, C had 20%. So this company should be the same, right? No matter how much total equity is, as long as A have 40% of the company, which is 40% of total equity, B have 40% and C have 20%, everybody should be happy because they are no different in material from on the goodwill method. Like I said, choosing of accounting method, at least at the beginning stage, should not affect your real ownership or whatever stuff in the partnership. So here we know that the total asset is how much? Total asset is 250, right? 250, and liability is 30, which means total equity. Sorry, total equity should be total asset subtract total liability, so equals to 220. And out of the 220, that's the total equity. We knew that A should have 40%. So total equity multiplied with the ownership of A when it was this goodwill accounting, and then B had a 40%, C had 20%. So using bonus method, we know that the capital under A's name was 88,000 at the beginning of 2010. For B was 88,000 as well. For C, it was 40, right? So we know that, okay, A and B have the same amount, A and B have the same amounts, and C is half of A, half of B, and C is half of A, half of B. We are all good to go, all right? So let's go to bonus method. Again, keep in mind, a workable, followable, straightforward format to solve accounting issues, accounting problems is extremely important. What I like is I like basically the base row from top to bottom, and sometimes it can change just based on how your format will look like, how the data look like. But I really recommend we have a workable format. Pay some time, spend some time on this, especially when you're working. It's going to pay off well, trust me. So allocation, 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 and we know Adam started with how much? 88,000. Okay, I'll link it so nobody will be confused where the number came from. Okay, so Adam had 88,000, and Betty started with 88,000 as well, and Carl started with, remember, 44,000. We just talked about it. I hope your memory lasts longer than 1 minute. Otherwise, we're gonna in deep trouble, okay? So here, what we know is total. Like I said, always have nice to have a total. It allows you to control, figure out what might be going wrong. So 220,000. And here we also know that for year one, how much money did they make? 50,000. So 50,000 here. That's the net income, right? So what is interest again? What is interest again? Rule number one, by the end of each year, a partnership receives 3% of beginning balance of capital, and if it's insufficient, blah, 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 right? So 3%. So 3% of the beginning capital of A should be 2,640. So same for Betsy, 2,640 and half of Carl, 1,320. And they add up to how much? 66,000. So this is smaller than 50,000 for sure. And we know after paying off the interests, the income, which was 50,000, had 43,400 left, right? So more than enough. More than 16,000. Why 16,000? Because step 2 is pay salary to Betsy and Carl, who work full-time for the partnership. So they will be, if raised enough fund, Betsy and Carl are supposed to get 8,000 each. If not, if there's not sufficient, given that they would have the same amount of pay, that's a qualitative definition, so the money will be distributed among the two evenly. So here we have enough. So Betsy, 8,000, and Adam, 8,000. Oh, okay. I wish Betsy must be wishing for 80,000 a year. So after this step, right? There's for step 3, how much do we have left? 27,400. That's enough for the P&L share, right? P&L share, if I remember correctly, 30, 20, 50. And keep in mind, this profit and loss share is different from the beginning balance portion, because beginning balance of capital talks about, or capital balance talk about at that moment, what is your share? Well, how valuable from the book value sense is your share for the business, right? The profit and loss share talks about every period, due to your work time, due to your expertise, due to your everything else, how hard you work, how much it is deemed of your contribution would be for the period, right? So it's a different, slightly different, very different concepts. So here, 30, 20, 50, let's keep that in mind, okay? So this is the total number for the partnership, for the 3 profits to distribute. And we know that A will get 30%, and then B will get 20%, and Carl will get 50%. And if this control is working again or not, yes, yeah, it's working actually. You notice what just happened, right? So this is amount sufficiently for step 3, and in step 3, it's going to be all distributed among the 3 partners, all the partners, right? So before this, I made a typo. What a typo was, when it should be 20%, I put 1%, right? I put 10%. So as a result, you can see that the total income distributing step 3 is smaller than the income available for step 3, when we had the knowledge that the income should all be distributed in step 3. So those 2 numbers should equal. But having this number here, having this number here, instantaneously, I recognize I made a mistake somewhere. So I check here, 0.3, 30%, no issue. Here, 50%, 0.5, no problem. And here we know that, okay, 10%, 0.1. So I know I made a typo here. So like I said, control allows you to recognize where you have a big screw up. However, control, if there's no issues, doesn't mean that you're right. You might still have some subtle mistakes, right? But at least it allows you to tell you when you have a big mistake. And of step 3, right, we said, okay, first, step 1 interest will be paid in cash, so won't increase capital, won't decrease capital. Same for salary. But for P&L share, 30% will be cashed out, 70% will be retained in the partnership, which means capital will be increased. So let's figure out here, 70% is so much. Right, so by the end of year, the capital is, there's a beginning, interest paid in cash, don't touch it, nothing for salary, and of the profit share, only 70%. So the total capital is 93,754 for Betty, and for Adam. For Carl, it began with 88,000, and interest is paid in cash, so it doesn't really matter. and the salary is paid in cash as well, doesn't matter, and retain the profit and loss share for Betsy was a profit of $5,480. However, Betsy would like to cash, I mean, 8,000 is definitely not enough for a year, so Betsy would be able to cash, would like to catch 30% of it, and keeping 70% retaining the company as retained capital or retained earnings, so the partnership might grow with its own fund, which is much more cost effective, efficient than either borrowing from external creditors or inviting some new guys in. Okay, so 70% of the 5,480 will be retained, increasing capital. So here we have Betsy, the capital balance of 91,836. Then follow the same logic for Carl, it's going to be this much. All right. So that's one thing we solved. Let's take a look at it here. Okay, second year 60,000. So we know, okay, end of 2010 equals to beginning of 2011. Right, so no issue here. So for that year, they made 60,000. No. And then interest is, if I remember correctly, 3%, right? Beginning balance is the end balance of previous year, so no problem. So after this, we know that there's a total interest of 7,175, which is much, much smaller than 60,000. So after paying off interest, there's 52,825 left, which is more than enough to pay off 4 months of salary of Betsy, 8,000, and a Carl, 8,000 as well, right? So after this, how much left? A lot. 36,825 left. How it's going to be distributed? Adam 30%, Betsy 20%, and Carl 50%. So, okay, total shared from step 3, the total is this number equals the income available. So at least we don't have a big mess up, right? And of this amount, we thought 30% will be cash used by every partner, A, B, and C, no difference. And only 70% will be retained. So we need to figure out how much the 70% is. This is one reason I like people when they work, they have access to computer. It's so easy and nice, and it's so important, such of a skill to use Excel. And if we do it in on paper, it doesn't make sense, you know, because nobody will do it on paper, and Excel allows your accounting stuff to be much, much more accurate. And if you're forced every time you're consciously using those formats, you're gonna get much bigger improvements. No one cares about your ability to write on a piece of paper because your boss won't care to read it. Or most likely your boss won't like it. So by the end of the year, follow our logic, 2011, did I use multiplication? Yes. This is a balance, everybody. Right? Then what happened next? What happened next again? Let's take a look. Okay, why present those differently and at the beginning of the same amount? Because at this critical moment when 2011 was changing to 2012, one thing happens. It's that Don paid 50,000 cash to the partnership, get 10%, and then you can be treated as equally as other folks, right? So let's take a look at this event. Here's what happens. And so let's put those right. That doesn't sound right. Pre-done. It's not a, you know, we are not in the English class, thank God, and I think everybody understands what it means. Right pre-done, right? Right before done joins in, we know the value BV of equity or BV of the net, or AKA net book value of partnership So we are talking about same stuff, all right? That's gonna be how much we know that already. It is 264,957. And keep in mind, so right, keep in mind, this method, bonus method, we don't allow goodwill to be created as long as the same partnership, which indeed we have the same partnership, right? So under this scenario, everything's measured based on identifiable assets. Then what we know is Don became a partner by contributing cash to whom? To the partnership, not anybody else, not buying shares from anybody else, but giving directly to the partnership. So partnership's net asset will be higher by how much? By 50,000. Because if you look at the partnership, Don contributed, and really not the lending or whatever stuff, and we didn't say partnership borrowed from anybody. So partnership's equity would still the same. Liability would be the same. Total asset would be higher by 50,000 due to the 50,000 cash, which means total equity will be higher by 50,000 on net. Book value of the partnership will be higher by 50,000 as well, right? So here we add 50,000. So BV or NBV, right, post done, meaning that right after done joins in, right? It's gonna be, I like to have a workable format, which now it's gonna be, okay. Then, if this partnership, right, if this partnership after Don contributes, the total equity of the partnership will be 314,957, right? That's total equity. And what's Don's share in the new partnership? If the Don's share is going to be Don 10%. What am I doing? Don is going to get a 10%. And of course, the partnership is on going up, right? So if Don pays 50,000 for a business that goes up for something with bright future, just like you know, if you are signing new players for NBA, whatever stuff, right? You want the best one, you pay much more money for this one. Hopefully, their future will be capitalized. They are demanded by a lot of people. So those stuff, right? So if we take a look and we know that, hey, Don paid 50,000, there's no reason which his capital will be 50,000 because he's buying into the future. Future is not capitalized accounting-wise yet, but he's buying that, right? So Don gets a share of the 10% of what we talk about. $31,496, right? And the Don pays 50,000. So, you know, Don paid 50,000, getting 31,494 for what reason? Because the partnership have the future. He needs to pay extra to buying. His extra goes to whom? Crystal clear, his actual payment goes to those whoever created the future, and who created the future, A, B, and C, right? So the money, the excess Don paid is actually Don paid 50,000, gets 31,496. So Don paid 18,504 bucks excess. Excess shared by whom? A, Adam, Betsy, and Carl, right? Shared by in what ratio? We said profit and loss share ratio capture their contribution, meaning they capture their contribution in creating the good future in our scenario. So unless being specified, we use a ratio here, right? So this number, this excess is shared by Adam, 30%, and by Betsy, 20%, and by Carl, 50%, right? So that's one thing we have. So we know that everybody's capital will be different. For Adam, they have that's there from the excess down paid, and then we'll get 5,500 and 51 more, and Betsy will have some more as well. And did I multiply again? Why I like it so much? And then we know for Carl, he's gonna get this much, and then we have now Don is part of it. His share is this much. So if you take a look, right, the total equity, total net value of the partnership again equals to 314,957, which is exactly the value, the book value after Carl, after Don contributed. Okay, so but we still need some more. Okay, new ratio. Why new ratio? We talk about it. Okay. Oh, the ratio. A, B, C, D. Let's see it again, right? So the new ratio was this much. Sorry, the old ratio was 30%, 20%, 50%. Right? And we know Don had 0 for sure because Don was not a part of it yet. Okay. However, what we know is, okay, Don at the new ratio in the new partnership, Don will have 10%, right? 10%. That's for sure. And then we know that there's no way for us to put 30, 20, 50 here, because if you do it, it's going to be 110%, and that's ridiculous. Okay. So what do we do? Again, one thing that is important is to make sure everything is fair. We did it already in Goodwill method, and we're going to do it again, right? So from here, we know that A, B, and C together, they used to have 100%. A had a half of it, C had a 30%, and B had a 20%, right? Of whatever A, B, C own together. So now, after Don took 10%, A, B, C together own 90% of partnership, which A will have 30% of 90%, B will have 20% of 90%, and C will have 50% of 90%, which will give you 27, 18, and 45, and which is our new partnership. So here we're going to keep in mind again, because every time there's structure change, we have to figure out the new ratio, right? New ratio, we focus on fair. What is being fair? Relatively, everybody is still the same. No one is proportionally much better off. No one is proportionally worse off. That's what we want, okay? So now we do it 2 times, you know. First, it's interest payments. Nothing too much worse. Specific attention, because I believe everybody knows it already, and then done, same. So, and we know that for the next year, they made a 30,000, which is a little bit which was a little bit shaky, and so that's how much. So after interest, there's a 22,551, which is good enough, more than 16,000, which is the salary paid for Betsy and the car, right? So after this, there's 16,000 left. Sorry, there's 16,000 paid. So we further subtract 16,000. There's 4,551 available for step 3, which is 30, 20. No, not 30, 20 anymore, but 27, 18, 45, 10. At least this time, Don gets some sweets, right? So we know that, okay, here, this number is available for step 3, and Adam will get a 27%, and we know here of the same available amounts, Betsy got 18%, and here Carl gets 45%, and Don got only 10%. So again, they add up to whatever we want. So of course, 30% will be withdrawn, 70% will be retained, right? So we figure out. Right. So without too much talking, let's see. Now we have the new balance here for everybody, which is voila, right? So let's talk about the next year. First, we talk about the interest again, 3%. So the total interest add up to 9,544. Okay, and we know that there were for 2000 for this year, 2013, there were 20,000 mates, right? 20,000 mates. They announced 20,000. So really bad because okay, after paying off interest, there's 10,456 left, which is definitely not enough to pay 8,000 for Betsy and 8,000 to Carl, right? So the money has to be distributed between the two equally. So we know that for Betsy, she's gonna receive half, and for Carl, he's gonna receive half of as well. So nothing to share for step 3. Of course, no 70% retained, right? So that's one thing we know. Okay, and because there's nothing for step 3, capital probably won't change. So by the end of 2000. Whatever, okay. Okay. So what happens? Bold thinking, Carl sensed it using his most experience, his superpower, right? And he sensed it, he wanted to leave, right? Again, we talk about if you run a business, right? If you run the business, if you are the leaving one, you always want to take as much as possible. If you are the retaining one, you want other people to take as little as possible. So what is a fair point? I think a fair point is to make sure, hey, the book might say it's worth as much, but my company is not worth so much. Or the book says worth as much, the company worth much more, I need to take more. So we are focusing how much of the company is really worth, and what's the really worthness of a company, and we know that it's going to be fair value. You can have somebody who trusts appraiser or whatever stuff, just tell you how much the value. Accountant, CPA, just tell you how much the company is. Here we assume it's given. When Carl cashed out, right, when he was there, the last moment, because we need to figure out the fair value, the market value of the company was actually 300,000. So we start from there, okay? So again, we do this, right? Write, free, or leave. We know that BV and DV of the partnership was how much again? Let's follow the same format. Was 3 plus, we have it here, 318,143, right? And then we know that fair value, still the same regime, right? Right before Carl left, fair value was, remember, 300,000. So fair value is lower. What is it I'm creating? I have no idea. So fair value is lower than book value by 18,143. So what does it mean? It basically says somebody, the CPA came in, tells the 4 partners, Adam, Betsy, Carl, and Don, right? Says, hey, I'm sorry, you two screw up. Almost use the F word. You two screw up. The good thing is you two didn't screw up that bad. You know, according to your book, the net value of the company was 318,143, right? However, according to my calculation, the company after screwed up by all of you by a little bit, is 300,000. So you screw up by 18,143, right? So again, who is you? The CP is referring to Adam, Betsy, Carl, and Don, right? What is a screw up ratio? How powerful you are, how screw up you are, right? So here we have the ratio already. The ratio is A, B, C, and D is going to be 27, 18, 45, 10. All right. So that's how screwed up, how much they contributed to what their share of screw up. Okay. So we know that of those share, basically the total value screwed up was 18,143. So A is responsible for 27 of it, B is responsible for 18% of it, and C is for 45%. Why is important? Because at that moment before CPA came in, right, everybody has a value which is from the book. But some damage has been done, maybe because somebody's lazy, maybe because car made some bad decisions, whatever stuff. But car is responsible for 45%, right? So no one would let car leave unless they figure this out, right? So on the book, right before CPA tell them you screw up, car's balance was 77,164 and a 64, right? So after CPA came in, figure out the value. Everybody's value should be a little bit lower, right? Lower by how much? CPA figures, so they screw up totally in lump sum by 18,143, and we have the share of their contribution to the screw up already. So let's do this. So thing number one, we know Carl's share is not 77,164. Carl's share has to be lower by this much, right? By this much. Issue number two, right? Remember, it's still the same partnership, right? We do not adjust for goodwill, no matter it's goodwill increasing or it's goodwill decreasing, right? We do not. So basically what we are saying here is Carl's balance should be lower by A164, right? A164. And basically what everybody told Carl is, hey Carl, let me ignore this, because here we are adjusting the value of everybody, and which we know we won't. And frankly speaking, we could, but we're going to be calling this goodwill method. It's bonus method, right? So let me figure out the logic, right? So let's go back. So technically speaking, those four screw up, all right? But those four are not leaving. They will stick with the boat. For them, they don't care about how their capital is adjusted because it's still the same company. It's still the same company without Carl, right? After Carl leaves. But what they know is they don't want Carl to take whatever he didn't deserve, right? So for them, the only single most important thing regarding Carl leaving is that, hey, how much can that Carl take with him? And we know the amount is 81.64, and the others don't matter. The others don't matter here, right? And then what do we do with 8164, right? And we can think about it because first, what we have here is, I have keyboard. What we need is, what would be the journal entry looking like again? We know we are adjusting the balance of Carl down first before he leaves, right? So C capital or capital Carl is going to be lower by A164, right? A164. So I guess the question here is, what do we credit? What do we credit? So let me ask. Sometimes I just told you, we can do some kind of calculation here. We can do some calculation here. We can do some ruling out. Do we credit asset? We are just adjusting. We are not paying car yet because we want to figure out how much car's balance is before car leaves. So we are not paying car cash yet. So no asset lost, right? So of course not asset. Any liability? Did they borrow to reduce car's balance? It's ridiculous, right? So no liability. And income, is there any income? Is the adjusting car down? Is it some kind of, you credit, is it income? Probably not. Expense, not. Dividend, no, right? So we only have equity to go. So, right, we know that it's going to be equity. So how do we rationalize it? Basically, whatever it says of the car, we are using bonus method. So we won't adjust based on the market value. But one thing you got to know is your balance at this moment shows, before the CP did the test, shows 77,164, but CP told us it should be done by A164. Basically, right, we all screw up at a different portion, but you screw up, you are leaving. So you are leaving a mess to us, and you need to compensate us, right? You need to give us bonus, we will let you leave. And it's going to be a fair bonus. When you are paying to all three of us remaining, you're going to pay whatever CPA thought you don't deserve, which is 8,164. And it should be distributed evenly among us. We're going to figure out, but you have to leave, right? So car, meaning that he's going to, out of his capital, move some to A, B, and C, A, B, and D. In what ratio, again, we can figure it out, right? So after car leaves, right, it's going to be ABD. Right? So when car was there, A, B, and D used to have 55%, 27, 18, 10, 55%. And after car leaves, we know that ABD will own 100%, but no matter their relative portion should not change. So what we know is going to be the new ratio is going to be after car leave, it's going to be, what am I doing here? Okay, I don't know what it is, but I'm not a very, to be honest, with the keyboard, this is my gaming laptop. Not really too much work here. How can it be? Okay, yeah. So what we know is sometimes you click, magic turns everything, right? So we know that when in the three-man game, A, B, and D, right, A will have the percentage will equal to 27 out of 55, B will have 18 out of 55, D will have 18 out of 55. So this payment will go to whom? Will go to, A, to make up whatever A thinks he lost. And B. And D. Because ABD, they write ABCD together, they messed up the boat a little bit. Boat appears to be thinking, but so C wants to leave, and ABD will be sticking with the boat. So there's not so A to AB and D, it don't matter how much they screw up from some perspective because they're sticking with it. And for C, if you want to leave the boats, meaning getting to the safe boat ahead of A, B, and D, so they need to reward by paying A, B, and D. They need to give A, B, a bonus, or he needs to be squared by paying off how much he screwed up, how big of a hole he made, right? That is the cover fix those ones. So he's going to be reduce his capital by 81.64 first, and those will go to A, B, and D in what ratio? 49%, 33%, 18%, because that's their new thing in the they are sharing the 81.64. So we know. So keep in mind, when we do using bonus method, it's always have a bonus sense to it, not really adjusting everybody, right? It's a bonus. So right before car leaving, we know that the capital of everybody should be here. For A, he's gonna get some more. And for Betsy, she's gonna get some more by making a not so smart using hindsight decision. And for Adam, for Carl, he's gonna paying his fund, but given the company is gonna go bankrupt, which was a spoiler I gave already, we know that it was not a bad call. Where's the number? Oh, what did I do? So folks, here we go. So what's gonna happen next is, here's now everybody is square, right? Now Carl can leave. So here it's gonna be easy. If Carl leave, everything from here will be erased, right? So Carl's balance will be lowered exactly by this amount because balance will be lowered. And as a company, of course, if you're leaving a company, hopefully you're leaving with cash, and this is what Carl wanted as well. So for the partnership, Carl left. Carl's name is 0 for his capital, so 69,000 credit debit to erase the capital of Carl to 0. And to let Carl leave without being too mad or be willing to leave, Carl would have received cash, which will be reducing the cash of the partnership by the same amount as well. So here's the journal entry we talked about. Again, catching the substance, understanding what they mean is the important thing. Writing down journal entry, if you understand what is going on, writing down the journal entry is always the easy part. All right, so here we finished the compare goodwill method and bonus method, and please practice on it. In the next video, we're going to talk about something else, really light job, and then it's going to be all. Okay, take care, guys.